Welcome to this analysis. I want you to think back over the last few years for a second. Because while the retail world and mainstream media were entirely distracted by the noisy, speculative frenzy of meme coins, something else was happening. A silent, highly calculated migration was taking place right behind closed doors. The smartest money on earth? Well, they weren't playing in the casino. They were quietly rebuilding the very foundation of the global financial system, directly on the blockchain. Okay, we're going to dive deep into this today, because what we're looking at is literally the most significant transfer of financial infrastructure in modern history. The contrast here is just stark. It's night and day. While the public was completely mesmerized by this retail distraction, chasing those volatile overnight returns, Wall Street was busy executing an institutional master plan. They aren't speculating. They're executing a deliberate multi-trillion-dollar strategy to migrate legacy global finance over to blockchain technology. Honestly, they kind of used all that public noise as cover to build the new reality. Section 1. Wall Street's biggest secret, the multi-trillion-dollar shift. Right now, the financial world's best-kept secret is a sector known as real-world assets, or RWAs. And to really grasp the sheer scale of what is happening right this second, just look at this number. $32 billion. As of mid-2026, the total value locked in the real-world asset sector has already shattered that mark. This is capital that has completely exited the clunky traditional banking rails and is now living and breathing natively on-chain. But as massive as $32 billion is, it is barely a drop in the ocean compared to what's coming next. $16 trillion. Just let the number sink in for a moment. Boston Consulting Group projects that this paradigm shift is going to explode into a $16 trillion market by the year 2030. And listen, this isn't just some crypto hype. This is a sober, analytical projection from literally one of the world's top management consulting firms. The migration isn't just happening, it's accelerating. Section 2, the mechanics of digital twins. Let's look at how tokenization actually works. So to really understand this shift, we need to look at the actual architecture. The crucial concept here is RWA tokenization. Think of it simply as creating a high-tech digital twin for literally anything of value in the physical world. Imagine you've got a massive, heavy 400-ounce gold bar sitting in a vault somewhere, or maybe a multi-million-dollar commercial skyscraper in Manhattan. Through tokenization, we take that single, highly illiquid asset and split it into millions of tiny fractional digital shares, tokens, that live permanently and immutably on a blockchain. And this right here brilliantly illustrates exactly why Wall Street is utterly obsessed with this transition. Legacy traditional finance is an absolute labyrinth. It's full of fee machines, endless middlemen, and agonizing wait times just to settle a single trade. In stark contrast, tokenization gives you trading 24 hours a day, 7 days a week, 365 days a year. But the real magic phrase you need to know is atomic settlement. That means the asset trade and the payment happen at the exact identical millisecond. No delays whatsoever, no counterparty risk, and no middlemen taking a massive cut of your money. Because at the end of the day, this isn't about ideology, right? It's about the bottom line, and the hard data proves it. JP Morgan actually ran the numbers and found that pushing transactions through their legacy systems cost them about $1.30 per transfer. But by moving to public blockchains like Stellar, for example, that cost a slash to practically zero. When you're processing millions of transactions a day, moving to a near-zero cost model isn't just a nice option, it is an absolute mathematical necessity for survival. Section 3. The Titans enter the game. Wall Street's heavy hitters. The pioneers driving this whole thing aren't rogue developers typing away in their basements. They are the most powerful, highly calculated asset managers on the planet. Let's review the tape here. BlackRock, the undisputed king of Wall Street, launched their BUIDL fund, which has rapidly surged past $2 billion in assets, expanding across Ethereum, Solana, Arbitrum, and more. Then you have Franklin Templeton's Benji Fund, which made history by using their tokens to officially settle a corporate merger and acquisition. That's a massive first. And JP Morgan's Connexus platform, it's already surpassed $1.5 trillion in cumulative volume, processing over $2 billion every single day. The momentum here is absolutely staggering. And guess what? They are going after the safest assets on Earth. Notice the stark difference in yield when you bring U.S. Treasuries directly on-chain. Traditional stablecoins basically offer a 0% yield, but tokenized U.S. Treasuries, they're offering 4 to 5% yields natively right on the blockchain. Because of this undeniable efficiency, these tokenized assets are actively displacing traditional, non-yield-bearing stablecoins. I mean, why hold idle cash when your digital dollars can generate government-backed yield by the second? It's a no-brainer.
Section 4. The collision of TradFi and DeFi, the composability flywheel.
Let's walk through this step by step, because honestly, this will change how you view capital forever. Step 1. You tokenize a traditional asset, like a piece of real estate or maybe a corporate bond. Step 2. Because it's now a blockchain token, you instantly plug it into decentralized finance protocols as collateral. Step 3. In a matter of milliseconds, you borrow stablecoins against that asset. No loan officers, no agonizing credit checks, no waiting around, just frictionless global liquidity. And we are already seeing this happen live. Right now, qualified institutions are using Aave Horizon to post their tokenized U.S. treasuries as collateral so they can instantly borrow capital. Meanwhile, BlackRock's massive BUIDL fund is actively trading on UniswapX. This allows these giant institutions to just swap their yield-bearing shares for instant liquidity with absolutely zero settlement lag. Those old walls between traditional banking and DeFi, yeah, they have completely collapsed. As the experts so brilliantly put it, tokenization is giving traditional assets financial superpowers. We aren't merely taking old assets and repackaging them into a new database. No, we are fundamentally upgrading their utility. We're granting them global reach, instant liquidity, and perfect transparency on a completely frictionless, worldwide scale. Section 5. The new economic reality. The post-hype era. So, the so-called crypto winter, it's definitively over. The era of empty hype has vanished. The institutional adults have officially walked into the room, and they've brought trillions of dollars in capital to deploy. If you take literally only one thing away from this entire analysis, let it be this. Wall Street has fully, undeniably realized that blockchain technology is no longer a threat to their business model. It is the mandatory, essential infrastructure they absolutely require to survive the next century. They aren't fighting it anymore, they are building upon it. So the question is no longer if tokenization is going to happen, but simply which asset will be the next to move on chain. When everything in the world becomes a digital token, what are you going to choose to own? A fraction of a Manhattan penthouse? Or maybe a piece of a high-yield corporate bond? Let me know your strategy down in the comments below. And hey, if you want to stay ahead of the curve as the greatest financial migration in history unfolds, make sure to hit subscribe and turn on notifications. The financial revolution won't be televised. It's being tokenized. I'll see you in the next analysis.